warm welcome to one and all. I'm Dr. Isha Narula, Assistant Professor, Vivekananda Institute of Professional Studies, Technical Campus. Today the topic we will discuss is portfolio evaluation strategies. Let us understand the meaning of portfolio evaluation first. The process of methodically examining an investment portfolio to determine its performance, risk exposure and suitability for an investor's risk tolerance and financial objective is known as portfolio evaluation. To make sure the portfolio stays optimum and successful over time, it entails evaluating a number of factors including returns, asset allocation, diversification and tax efficiency. Finding out if the portfolio is fulfilling the investor's goals such as asset preservation, income creation or capital growth within an acceptable risk tolerance is the main purpose of portfolio review. Return on investment, risk-adjusted return and comparison to benchmark like market indexes are important assessment indicators. Examining the portfolio structure, maintaining diversification and assessing for overexposure to particular industries or assets are further component of the examination. It assists in locating underperforming investment and potential areas of restructuring or rebalancing. Furthermore, portfolio review takes into account both individual changes such as change in risk tolerance or financial objectives, as well as external influence such as market movements, interest rates and economic shifts. Maintaining financial discipline, enhancing performance, successfully managing risk and guaranteeing long-term financial success all depends on routine portfolio assessments. It facilitates efficient portfolio management and strategic decision making. There are mainly three techniques of portfolio evaluation, namely risk-adjusted return matrix, benchmark comparison and risk exposure analysis. The first technique we are going to discuss today is risk-adjusted return matrix. Risk-adjusted return matrix measures the return of an investment relative to the amount of risk taken. These metrics help investors assess how well an investment compensates for the risk involved. It is also known as risk premium, which means how much well an investor is getting paid for taking risk. One obvious method of adjusting for risk is to look at the reward per unit of risk. We know that investment in stock is risky. Risk-free rate of return is the return that an investor can earn on risk-free assets. The return earned over and above the risk-free rate is the risk premium, that is the reward for bearing risk. If this risk premium is divided by measure of risk, we get the risk premium per unit of risk. This reward per unit of risk for different portfolio or mutual funds may be calculated and the funds may be ranked in descending order of the ratio. A higher ratio indicates better performance. There are two major ratios which are used for evaluating the performance of the portfolios, which are Sharpe ratio and Trenor's ratio. Sharpe ratio, let's understand the meaning of Sharpe ratio first. The performance measure developed by William Sharpe is referred to as Sharpe ratio or reward to variability. It is the ratio of reward or risk premium to the variability of return or risk as measured by the standard deviation or return. The Sharpe ratio compares the overall volatility of the portfolio with the excess return above the risk-free rate. Better risk-adjusted performance is indicated by greater ratio. The formula for calculating Sharpe ratio is stated on the screen, which is Sharpe ratio equals to Rp minus Rf divided by sigma p, where Rp is realized return on the portfolio, Rf is risk-free rate of return and sigma p is standard deviation of the portfolio. Now let's understand Trenor's ratio. The performance measure developed by Jacques Trenor is referred as Trenor ratio or reward to variability ratio. It is the ratio of the reward or risk premium to volatility of return as measured by portfolio beta. The formula for calculating Trenor ratio is stated on the screen, which is Rp minus Rf divided by beta p, where Rp is realized return, Rf is risk-free return and beta p is portfolio beta. To understand the calculation of two ratios, let us consider an example. The return and risk figures of two mutual funds and the stock market index are given in the table. Here you can see two funds A and Z with the respective returns in beta and market index as well as their beta values. The risk-free rate is 7%. As you can see the calculations on the screen, the Sharpe ratio for A is 0.277 and Z is 0.48 and M is 0.40. As per Sharpe performance measure, fund Z has performed better than the benchmark market index, while fund A has performed worse than the market index. Now you can see calculations on the screen. The Trenor ratio for A is 7.14, for Z is 9.23 and M is 8. As per Trenor performance measure, fund Z has performed better than the benchmark index, and while fund A has performed worse than the market index. Now we will understand another concept called benchmark comparison. The technique of evaluating a portfolio's efficacy by comparing its performance to a pertinent standard or index is known as benchmark analysis. Here's a step-by-step guide for doing it. The first point is select an appropriate benchmark. A crucial first step is effectively assessing portfolio performance is choosing a suitable benchmark. The investing approach, asset allocation and risk profile of the portfolio should be closely matched with benchmark. For example, a bond-focused portfolio may benchmark itself against the Bloomberg US Aggregate Bond Index, whereas a portfolio predominantly made up of large cap US equities may use the S&P 500. A composite benchmark that represents many asset classes could be necessary for a diversified portfolio. Inaccurate performances reviews may result from selecting the incorrect benchmark. Fair comparisons are made possible by a well-matched benchmark, which also helps distinguish between talent and market-driven returns and directs long-term strategic portfolio changes. Second point is measure portfolio performance. Calculating the entire return produced by the assets over a given period, including capital gains, dividends and interest incomes, is necessary to assess the performance of the portfolio. For perspective, this is usually compared to a benchmark and can be represented as a percentage. Both absolute return and risk-adjusted indicators such as alpha and Sharpe ratio are also used to quantify performance. To find patterns or volatility, it's critical to take time periods into account, such as monthly, quarterly or yearly. Investors may monitor their progress towards financial objectives, make well-informed decisions and assess if their present investment plan is working or needs to be modified to increase returns or lower risk by using consistent measurements. Third point is compare returns. It is possible to determine whether an investment plan is performing satisfactorily by comparing the outcomes of the portfolio with the benchmark. Begin by coordinating the benchmarks and the portfolio's assessment periods. Subtract the benchmark return from the portfolio return to determine the excess return. Outperformance is shown by the positive excess return and underperformance is indicated by negative outcome. Fourth point is analyze risk-adjusted performance. Determining how well a portfolio produces returns is in relation to the risk assumed is made easier by examining risk-adjusted returns. The Sharpe ratio, which contrasts excess return above the risk-free rate with overall portfolio volatility, is common indicator. A great ratio denotes superior performance per unit of risk. The Trenor ratio assesses return in relation to beta and the market risk. Fifth point is interpret results and adjust. Determine whether the portfolio fits with your risk tolerance and financial objectives by evaluating risk-adjusted returns in performance comparisons. While underperformance may suggest inadequate diversification, bad asset selection, or problems with market timing, outperformance may suggest a successful approach. Reallocate to more stable assets if the portfolio exhibits excessive risk or volatility. Restoring the desired asset allocation may require rebalancing. Long-term goals should be the focus of strategic, not emotional adjustments. The portfolio is kept effective, risk appropriate, and in line with changing market circumstances and financial objectives by routine evaluations and modifications. Now we'll understand risk exposure analysis. Analyzing risk exposure entails determining the kinds of amounts of risk to which a portfolio is exposed. This covers, among other things, market risk, interest rate risk, credit risk, and sector-specific risk. These risks are quantified with the aid of instruments such as value at risk, standard deviation, and beta. To make sure the portfolio isn't too concentrated on one asset, industry, or area, diversification is evaluated. The objective is to determine whether the risk level of the portfolio fits the investor's financial objectives and risk tolerance. Changes can be made to reduce excessive risk and improvement in light of the findings. Now let's discuss the techniques of risk exposure. First is standard deviation. A popular statistical method for assessing portfolio risk is the standard deviation, which computes the variability or dispersion of returns around the average return. Greater volatility is indicated by higher standard deviation, which suggests higher risk because the returns on the portfolio move more widely. On the other hand, a lower standard deviation indicates less risk and more consistent results. Investors can better grasp the unpredictability and possible departure from projected returns by using portfolio analysis. When comparing the risk levels of various investments and determining if the amounts of risk assumed is in line with an investor's risk tolerance and financial objectives, standard deviation is crucial. Second is beta coefficient. The beta coefficient indicates the degree of systematic risk associated with an investment by measuring its susceptibility to market changes. An investment that has a beta of 1 moves in lockstep with the market. Higher volatility than the market is indicated by higher beta than 1, whilst lower volatility is indicated by a beta less than 1. An asset with a negative beta is said to move against the market. The capital asset pricing model, which estimates projected returns based on market risk, relies heavily on beta to match portfolio risk to the individual risk tolerance and investing objectives. Investors utilize beta. Third is value at risk, which is called VAR. A risk management statistics called value at risk calculate the highest possible loss a portfolio might sustain over a specific period of time at a particular degree of confidence. A one-day VAR is of $10,000 with 95% confidence, for instance, indicate that there is 95% likelihood that losses won't surpass $10,000 in a single day. VAR assists investors in comprehending downside risk and becoming ready for the worst case situation. Financial institutions utilize it extensively to measure risk exposure, establish boundaries, and make well-informed choices about capital allocation and risk taking. Fourth is scenario analysis. A risk assessment method called scenario analysis looks at how a portfolio may do under various fictitious circumstances or economic environment. Market collapses, interest rate fluctuations, recession, and geopolitical crisis are a few examples of these scenarios. Investors can evaluate the portfolio's susceptibility to different risks and project possible gains or losses by modeling these scenarios. This aids in finding flaws, evaluating how resilient investing methods are, and making well-informed choices to modify risk management or asset allocation procedures. Proactive planning and improved readiness for unforeseen future occurrences are supported by scenario analysis. Fifth is stress testing. A risk management method called stress testing assesses how well a financial system or portfolio function in the face of severe yet conceivable unfavorable circumstances such as market meltdowns, recessions, or abrupt increases in interest rates. In contrast to scenario analysis, stress testing evaluates possible weaknesses by concentrating on uncommon, extreme situations. Finding vulnerabilities and projecting possible losses is the worst case scenario are the objective. By comprehending the effects of unforeseen high-stress market settings, stress testing assists investors and institutions in improving risk controls, preparing for financial shocks, and making more robust investment decisions. Sixth is correlation analysis. The degree to which two or more assets move in relation to one another is measured by correlation analysis. It is represented by a coefficient between -1 and +1. +1 indicates that assets move in unison. A value 0 denotes no association. Assets move in exactly opposite direction. The value is -1. Correlation aids in evaluating the advantages of diversity in portfolio management. Because gains in one asset may balance losses in another, combining assets with low or negative correlations lowers the total risk of the portfolio. Building a balanced portfolio that maximizes returns while lowering risk exposure is made easier with an understanding of correlation. Eighth is concentration analysis. The degree of a portfolio's heavy reliance on a particular asset, sector, industry or geographic area is assessed with concentration analysis. A high level of concentration raises risk since subpar performance there can have a big effect on the portfolio as a whole. By distributing investments over a range of assets and industries, diversification lowers the risk of concentration. In order to create a more robust, balanced portfolio, this analysis aids in identifying overexposure and director rebalancing choices. To guard against unforeseen losses and make sure that no one investment has an undue impact on performance of the entire portfolio, concentration risk management is crucial. Thank you so much everyone for the patient listening. We'll see you with few more topics in coming classes. Thank you very much.